Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Carnival Corporation and PLC annual report. Carnival Corporation and PLC offers a diverse range of businesses and services to cater to the leisure travel needs of its customers. The company operates through four main segments: NAA Cruise Operations, Europe Cruise Operations, Cruise Support, and Tour and Other. Under these segments, Carnival provides various services including cruise operations, port destinations, and island management. Additionally, the company owns and operates a range of accommodations such as hotels, lodges, glass-domed railcars, and motor coaches. This allows customers to experience different modes of travel and stay options while on vacation. The company's portfolio also includes several well-known brands that offer cruises under their respective names. These include AIDA Cruises, Carnival Cruise Line, Costa Cruises, Cunard, Holland America Line, P&O Cruises, Australia, P&O Cruises, UK, Princess Cruises, and Seabourn. Customers can book these cruises through various channels such as travel agents, tour operators, vacation planners, websites, and onboard future cruise consultants. Overall, Carnival Corporation and PLC provides a comprehensive range of businesses and services that cater to the diverse needs of its customers in the leisure travel industry. Carnival PLC's stock price has experienced a modest increase of over 12.12% in the past year due to several key factors. The company's financial results have been a major driver of this growth, with record-breaking operating income, revenues, and net yields reported throughout 2025. In the first quarter of 2025, Carnival announced record revenues of $5.8 billion and significant outperformance in net yields compared to guidance. The second quarter saw the company exceed both earnings per share and revenue forecasts, with adjusted net income more than tripling compared to 2024. The third quarter was also a strong period for Carnival, with all-time high net income and revenues reported. The fourth quarter concluded a phenomenal year in 2025, with record financial results announced for both the quarter and full fiscal year. In addition to these strong financial results, Carnival's strategic announcements have also contributed to investor confidence. The company reinstated its quarterly dividend at $0.15 per share and achieved investment-grade leverage metrics. Furthermore, positive analyst outlooks and booking trends for 2025 and 2026 have also boosted investor confidence in the stock. Overall, these factors have combined to drive Carnival's stock price increase of over 12.12% in the past year. Carnival Corporation and PLC maintains a market capitalization of $38 billion, broadly in line with the industry peer group. Carnival Corporation and PLC trades at a lower price-to-earnings ratio of 14 times and a higher price-to-book ratio of 3.04 times relative within the industry. But when we look at the broader industry, much for its peers are also priced fairly or higher. This indicates an overall sector-level optimism, suggesting that most investors have already participated in the industry, leaving limited opportunity to uncover undervalued stocks. The company exhibits a very high leverage profile, with liabilities accounting for 81% of total assets. This elevated debt level warrants heightened caution, as it may limit the company's financial flexibility and increase risk during economic stress. We have to further examine the industry and the nature of the business to determine if they justify the current valuation. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth or decline in the cruise industry are multifaceted and influenced by various factors. On the growth side, demand for cruises is a significant driver, particularly during peak seasons such as the third quarter. Cruise itinerary length also plays a crucial role, with longer itineraries booked further in advance contributing to increased revenues. Pricing strategies, including varying prices based on season, category of guest accommodation, and itinerary, are another key factor driving revenue growth. Onboard and other revenues, which account for 34% of cruise revenues by 2025, also contribute significantly to overall revenue growth. Effective marketing activities, sales channels, internet booking engines, social media presence, and strong relationships with suppliers all play a role in driving revenue growth. On the decline side, incidents concerning ships, guests, or the industry, adverse weather conditions, fuel costs, overcapacity, and competition are significant drivers of revenue decline. Additionally, cancellation fees, increases in ticket prices due to various factors such as accommodations, meals, and onboard amenities, and refunds of customer deposits also contribute to revenue decline. In terms of specific segments and regions, the North America segment has experienced revenue growth due to the entry of new ships and transfer of existing ones, while the Europe segment has seen revenue growth due to the entry of a Cunard ship. However, revenue decline in certain segments and regions is attributed to factors such as departure of ships from these markets. Overall, the cruise industry's revenue growth or decline is influenced by a complex array of factors, including demand, pricing strategies, marketing activities, sales channels, and external events such as incidents and weather conditions. Net income for the company experienced fluctuations over the years. Initially, it increased due to strong profitability and double-digit return on invested capital, ROIC. However, this trend was disrupted by various factors such as increased debt servicing costs, higher fuel prices, loss of key team members, and reduced demand for cruises. Additionally, supply chain disruptions, foreign currency exchange rate fluctuations, overcapacity, and competition in the cruise industry also contributed to a decrease in net income. Despite these challenges, the company's net income saw an increase of $909 million to $4.5 billion in 2025 from $3.6 billion in 2024. This significant improvement was likely due to the company's efforts to control costs, reduce debt, and invest in strategic initiatives such as newbuilds and destination development. Profit margins also underwent changes during this period. Initially, they improved due to disciplined cost control and measured investments. However, a decline was observed due to higher energy costs, reduced demand for cruises, increased airfares, and supply chain disruptions. Despite these setbacks, the company's operating income reached an all-time high of $4.5 billion in 2025, representing a 25% increase from the previous year. Overall, the company's net income and profit margins were influenced by various factors, including changes in market conditions, operational efficiency, and strategic investments. While there were periods of decline, the company was able to recover and achieve significant improvements in its financial performance. The company is indeed generating positive operating cash flow. This is evident in the financial statements provided, which show a steady increase in net cash flows from operating activities over the past 3 years. In 2025, the company reported $6.2 billion in net cash flows from operating activities, a significant improvement from the previous year's figure of $5.9 billion. Even more impressive is the comparison to 2023, where the company generated $4.3 billion in net cash flows from operating activities. Furthermore, the company's ability to recognize revenues from customer deposits exceeding the balance of customer deposits suggests that it has a strong and stable revenue stream. This not only contributes to its positive operating cash flow, but also indicates a high level of customer satisfaction and loyalty. Overall, these indicators suggest that the company is in a healthy financial position, with a solid foundation for future growth and success. The company's debt level and interest expenses have undergone significant changes over the past few years. In terms of debt, the total debt has decreased from $27,475 to $26,640, indicating a reduction in debt levels. However, this decrease is not consistent across all periods, as seen in the fluctuation between 2026 and 2027, where the debt level increased significantly. Regarding interest expenses, there are mixed signals. On one hand, interest expense decreased by $406 million, 23%, to $1.3 billion in 2025 from $1.8 billion in 2024. Additionally, interest expense, net of capitalized interest, also showed a decrease in 2025 compared to 2024. However, the interest expenses as a percentage of total debt have increased due to changes in market interest rates. Overall, while there are some fluctuations in debt levels and interest expenses, it appears that the company has made efforts to reduce its debt burden over time. The financial performance of various segments within the company has been analyzed, revealing both strong and weak areas. In terms of well-performing segments, North America stood out with a significant adjusted operating income of $3.233 billion. Europe also demonstrated impressive results, achieving an adjusted operating income of $1.61 billion. On the other hand, the cruise support segment struggled, recording an adjusted operating loss of -$468 million. This underperformance highlights areas where the company needs to focus its attention and resources to improve efficiency and profitability. Management is optimistic about the company's outlook, emphasizing its commitment to sustainability and growth. The key strategies outlined include prioritizing differentiation among cruise lines to attract unique customer profiles, executing a sustainability roadmap to reduce environmental impact, and strengthening the balance sheet while delivering shareholder returns. A crucial aspect of management strategy is providing an exceptional cruise experience through strategic sourcing and supply chain management. This involves building strong relationships with suppliers based on shared values and ethics, as well as investing in leadership development programs to build strong leaders and retain top talent. The company has set ambitious targets for sustainability, including pursuing net zero emissions from ship operations by 2050. To achieve this goal, management plans to invest in technologies such as LNG-powered cruise ships, advanced air quality systems, shore power, and efficiency upgrades. In terms of financial strategy, management aims to use existing liquidity and future cash flows from operations to fund its requirements. The company also seeks to manage credit risk exposures by conducting business with well-established financial institutions and diversifying counterparties. Furthermore, management plans to unify the corporate structure under a single entity, with Carnival Corporation as the parent company and Carnival plc as its wholly owned subsidiary. This move is expected to simplify operations and improve efficiency. Overall, management strategy focuses on sustainability, growth, and financial discipline, positioning the company for long-term success in the global cruise industry. The company's financial activities have been documented in various reports. One notable aspect of their operations is the payment of dividends. According to the records, the company has indeed paid dividends on multiple occasions, as mentioned in pages 3, 32, 44, and 66. However, when it comes to share buybacks, the information is less clear-cut. While there are no explicit mentions of share buyback activities in most reports, one notable exception stands out. At the 2025 Annual General Meeting, Carnival plc did not renew its authority to purchase shares, indicating a deliberate decision to refrain from buying back shares at that time. Supply chain disruptions and inventory buildup concerns the travel industry is facing significant challenges due to various factors. One major concern is supply chain disruption, which can be caused by a range of issues including international sanctions, heightened regulations around customs and border control, and travel bans to certain geographical areas. Additionally, disruptions in logistics, information technology, or transportation systems can also impact the supply chain. Furthermore, labor actions, increased demand, production, or distribution problems can all contribute to supply chain disruption. These factors are beyond the control of companies and can have a significant impact on their operations. The potential for inventory buildup is another concern, particularly when port costs do not vary with guest head counts. This can lead to inefficiencies in the system and put pressure on companies to manage their inventory levels effectively. Overall, it is clear that there are concerns about both supply chain disruption and inventory buildup in the travel industry. Companies must be proactive in managing these risks and developing strategies to mitigate their impact. That concludes the financial summary for Carnival Corporation and plc. Feel free to comment below, and I will be happy to answer them when possible.